Good day, everyone, and thank you for joining us. This is Jason Lisui, and I'm joined by our CEO, Jeremy Fehr. Our agenda today, as you can see, is as follows. I will introduce our latest video. This one discusses the concept of the two-way player, if you haven't already seen it, and ultimately its importance in changing the way many sports were played. And of course, this is the essence of our true tactical approach to investing as well. I will then turn it over to Jeremy for his Q&A segment, where he will address several questions we have received from advisors over the past month. Additionally, if there are any other questions, please feel free to type them into the question box, and we will respond to each one individually after the webinar. So for now, please play the video.
It's been said that offense wins games, but defense wins championships. Historically, in some team sports, these were considered separate roles. Then a change took place that revolutionized how many sports were played. The emergence of the two-way player, someone who could play both offense and defense and would automatically switch between these roles depending on the flow of the game. The addition of the two-way player added a tactical dimension to a team by providing offensive or defensive support where and when it was needed most. Challenging the status quo, SIA Wealth sought to redefine the parameters of a traditional equity mandate in order to enhance an investor's ability to compete in the markets. An equity mandate that was designed as a two-way strategy, the true tactical approach. Traditionally, most equity mandates remain invested throughout the market cycle and will typically follow the pattern of the market in both directions. The two-way strategy would seek to play offense by overweighting equity exposure during longer-term rising markets, and play defense by decreasing equity exposure during longer-term declining markets. By automating this shift between offense and defense, the two-way player can improve a portfolio's ability to adapt to changing market conditions by actively managing risk within the market cycle over time. Successful portfolios, like winning teams, balance offense and defense. Let SIA Wealth be the two-way player in your portfolio. Invest to win. Invest in true tactical.
Great, thank you. And if you go on to the next slide, and one more. So here we've also just showing you just quick pictures. We've also created a brochure to accompany this video to support your conversations with clients. In thinking back, we think a great example of the two-way player in action was the bear market last March 2020, where we reduced equity exposure to virtually zero during the worst part of the decline. The bailout then occurred, and then by the end of April 2020, we were back at 100% equity allocation. So we played both offense and defense during that difficult period in the markets and really showcased our true tactical nature. Please feel free to reach out to us if you'd like to learn more about how advisors are incorporating these videos in their own marketing efforts. And now I'll turn it over to Jeremy for his Market Insights Q&A.
Thanks, Jason, and thanks everyone for taking the time today. We're really excited about our true tactical messaging and what we've done with our mandates over the last, 6 years at SIA Wealth Management. So it's great to have you all aboard to see that video as we came out with that new marketing plan today. Our market insights for this month, we've got 4 questions that have come to us from you, the advisors out there. So please keep sending them in. There's been some great questions, and it's always challenging and fun to work on these every month. So without further ado, the first question is, how will the Federal Reserve respond to surging U.S. inflation? So the first slide here, what we're doing is showing a long-term view of inflation going back to into the early 20s. And what we can see from this inflation chart from the United States is that the first, years from 1920, or first 60 years up into the early 1980s, we see a very, very volatile inflation chart. From the early 1980s on, though, we see that it is very much stuck in a range. We got a range anywhere from 0 to about 5%, a couple of instances where we move above that. So in context, our higher inflation that we've seen lately in this post-COVID world still falls within our historical norms going back to the early 1980s. The Fed is likely not going to act aggressively unless we break out of this trend in a material way. So when we look at what we're going to do from an investment portfolio standpoint, we should be cautious about watching these short-term numbers. The Fed has been talking about transitory inflation. Whether or not that's going to happen or not is yet to be determined, but probably watching this chart here and monitoring how far we go up in there. We're going to need a significant spike for them to move away from their low interest rate environment. The response, I found this chart today, I found it, recently, which I found extremely valuable, and it just compares the S&P 500 to what's happening with the Federal Reserve and their buying assets. So essentially quantitative easing in the marketplace. We can see from the bottom of the 2020 correction in the COVID time in March there, we see that quantitative easing really spike up, move aggressively, and we see the S&P 500 move up with it. So as we look at the charts, we can see that they've moved very much in line with each other. We can also see that the quantitative easing is still continuing. We haven't seen a deterioration in that. So that inflation effect could be there, but I think the greatest risk that we all have on this call here is when that inflation, if that inflation goes above that 5% in a material way, gets outside that range and appears to be staying here, is that quantitative easing is likely the area where they're first going to react, which is going to, should have or could have a very significant impact on equity valuations, who have really tracked the money flows that have been put back into the market as the Federal Reserve has been buying assets and freeing up the banks to put more of their capital to work. Another area where I think we should watch, and I feel is important, I've commented on these in the past, is I've got the 5-year CBOE interest rate on the left, the 30-year on the right. When we look at these charts, what we can see that's happening, though, is since April that we've seen a top in those yields. So those yields are actually coming down. So is that the quantitative easing that the Fed's had has finally reached that tipping point where they've absorbed most of the material supply out of the bond markets, and other buyers are now coming in, but we're seeing yields trail off. So this is, I think, an important note right now when we talk about inflation, that at least in the near term here, it looks like there is some forecasting or the quantitative easing has reached a capacity to reduce the yields and move them back down, which is where obviously the Fed would like them to be. So when it comes to what's going to happen with inflation, it's that quantitative easing. We would expect that the Federal Reserve would ask the banks to purchase assets rather than them, and taking up some of their capital and reduce it here there, which would potentially have a significant impact on equities. But in the near term, when we look at the charts here, I think we can be a little bit more cautious about making a big move based on inflation, and we have additional charts coming up here that are talking at some of the drivers of inflation recently. The next question we have is what's next for the S&P TSX Composite Index after surpassing the 20,000 level for the first time in history. So clearly a very material psychological benchmark to get through, resistance level to get through. But what it looks like from a technical standpoint is still very bullish for the TSX Composite. So the chart looks really good. In early June here, we moved above that psychological 20,000 level. We've got that. The upside potential on a risk-reward basis remains really good. We've got first resistance around 22,000 and second resistance in that 23,000 level. So with support nearby above 18,850, we've got a reasonable risk-reward on it. Near term, we're a little bit cautious. We do appear to be overbought here. If you're watching our Canadian mandate, the ZFC, what you'll see is that we've been raising some cash in that. So we do see some short-term indicators that are weak within the broader market, but in the context of what's happening in the S&P TSX Composite over the intermediate and longer term, it still is favorable. So what's driving it? It's really coming down to two sectors recently. We've got energy on the top column or top row here, and we've got banking on the bottom row here as well. So energy in the top left corner, we can see the energy equal weight index. This is from the SIA Energy Equal Weight Index, has moved up very, very strongly over the first 6 months of 2021. Some drivers in it that are top ranked investments going forward. Cenovus Energy, Imperial Oil, again, have been driving that. On the banking side, we can again see that it has moved up a little bit of a pullback here recently on an equal weight basis, but we can see that National Bank, which is the top ranked bank within the S&P TSX 60 index that we measure, as well as Bank of Montreal, are the top two. So they've had a slight little pullback here, but these have been the main drivers that punched us through that 20,000 level, is these two sectors. So we got to watch them closely. Banking, you can see that it's rolled over slightly here. Energy, it seems to be a little bit stronger as we move through this week, with oil prices continuing to surge and move upwards there. So we see those charts with a little bit extra strength on it, but it really comes down to that. And then we have potential seasonality coming up going into it. But the TSX Composite overall looks very, very positive. Some near-term broader economic or broader market indicators have weakened slightly. The next question is lumber correction. Since the high in early May 2021, lumber has declined almost 40%. Is demand for lumber waning, or has supply increased, or both? The first thing we're going to look at here is the chart on lumber. We can see that parabolic move that started right from the bottom in April of 2020, as we moved from that $250 range all the way to highs in that 1,675 or 1,626 range. So a very, very dramatic run up on lumber. Certainly one of those inflation places that everyone's pointing to right now. But what we've seen since May is that we've seen a pullback on lumber, and has moved down below 1,000 as of yesterday. So for the first time in quite some time, we're starting to see some reduction in lumber prices. So from a risk reward buying this chart, we've got a short-term S-max that is negative. It is more than likely that we're going to test that 849 level on support here, pulling on my technical analysis cap here. Not a lot of support levels below that. There are some shorter term ones there, but on a longer term basis, looking at this chart, it would appear that that 600, 630 range is going to get tested if we're looking at the chart today. So the direction for lumber appears to be negative on not just a short-term basis, but on an intermediate-term basis as well. So what's driving this? The top quote out here is that the U.S. lumber production has responded to the price rally by ramping up output by 5% over the past 12 months, with another expected increase of 5%, or roughly 1 billion board feet coming out in 2021 into 2022. And I can account from this, living in the mountains and near British Columbia, the loggers have been working very, very hard and very fast over the winter months preceding the spring that we just arrived. So that supply side has been worked at with it. What's also important about it is in the second quote is, I'll just read the highlighted section here, buyers are balking at the still historically elevated prices and awaiting additional supplies. So this is a bit of a double-edged sword for us if we're hoping that lumber prices are coming off dramatically. Yes, those buyers are sitting on the sidelines, but they do have orders and will need to go into the market at some point. So they're delaying their projects. They're working hard to not buy in the current marketplace, which is reducing demand. But the expectation is that that demand is going to come back and sink us in. So in my opinion, it looks like we could be sitting in that 600 to 800 range for the foreseeable future if we get down into it. If we look at to the left, in the bottom left here, we have the lumber contracts. We can see July priced in the 982 range, with March 2022 priced in that 676. So the market is clearly forecasting lower prices for lumber. Although this would seem a good direction and certainly will help with that inflation cause, when it goes to housing and how it gets measured through there and renovations, et cetera, dramatically reduce those costs. But we still are going to have prices that are going to be substantially higher than where we are post-COVID, looking at it. The next question, cryptocurrencies had a big run back in the winter, but have been dropping back in recent weeks. Is this play over for now, and what does it mean for gold? Certainly crypto has been an area where we've all been following, some have been participating in, and clearly one of the most innovative investments in our lifetimes, a currency that is based on nothing, very similar potentially to what we have in many countries around the world. But what's happened here is that crypto, after reaching up into the 60,000s, has reversed back down and is now below 40,000 very, very quickly over that. So it still remains a top performer when you look on a year-over-year basis. But what's important about looking at the chart here is that we do have what appears to be a strong resistance level at this 40,000 level. We'll see if we can get through that. We would expect that there's going to be what I would call rabid followers, those who are pro crypto. It appears to be two camps in that universe, where there's followers who are extremely bullish and see this as the future, and those who consider it a fraud and go from there. But the rabid followers are still bullish. Where the risks lie for crypto are government intervention. We've seen this around the world from time to time from governments such as China and others. Lack of assets backing it, so potentially any leverage in that model could potentially create some risk and downside for it as well. And then just to the point where we looked at a little bit earlier over the presentation, where early on we can see that the yields are starting to back off, bonds are being purchased again. We can see that lumber prices are coming off, and some other commodities, even copper, has come off a little bit. So some of those inflation pressures may be starting to come off a little bit. We'll wait and see that. But if inflation comes off, that's been clearly a big driver for crypto going forward. So how does that work into gold? I think it's a tale of two cities with this, is that gold, which has traditionally been that product, that safety net that investors would go to when times are tough, just didn't do it this time to its old standards. With crypto coming in and the new wave of investing and the simplicity of buying the crypto and honestly the fun of it, clearly gave it more of a run. But unlike crypto, gold's chart appears to be intermediate term bullish. So we do have a pullback in it. We do see us rising in a column of X's, which is bullish for it. So we still remain in a bull market for gold here. Gold has some additional help that can provide it some support in a world where maybe crypto is being hurt just from its industrial values in both manufacturing and jewelry production, which have been both sitting on the sidelines to some degree, and I believe the jewelry in a large degree over the COVID crisis as the world starts to open up. So the other factor is that gold has, if nothing else, has centuries and millennia of being a standard that people can go to, where crypto is relatively unnew, relatively untested, and we're likely seeing that test right now. So near term, it appears like crypto is in more trouble, and gold would be the preferred between those two investments from there. So that concludes this monthly's webinar, the questions. So we do appreciate you sending those questions in. I do believe that we are going to take questions. If you have them, you can type them in, and I'll let Jason jump in if there's any questions that any of you have about the presentation this month.
Yeah, thanks, Jeremy. And at this point, we don't have any questions coming in here, but we do receive a lot of questions afterwards. So please continue to send those in if you want us to respond to you right away. You had an urgent question. We will definitely respond right away. In addition, if you have any questions over the month, please feel free to send them in to sales@siawn.com, and we'll compile them. And the most asked questions we'll send on to Jeremy to respond to for next month, which will be in mid-July. So thanks everyone again for joining us today. Again, we'll be back in mid-July for our next Market Outlook webinar. Until then, have a great week, everyone.
Thanks, everyone. Look forward to seeing you next month.